Hey guys. Hey Yefeng, what was that FX report you wanted?
It just says like the Japanese yen FX trade is like the carry trade is not fully unwound. It's like I don't know exactly which one it is. I just saw the headline.
Yeah. Let me see if I can find it because I'm subscribed to a lot of these, but maybe uh, do you know who the author was?
Let me see. I think the
Oh, was it it's FX Market Weekly, right?
yeah, I think in the it says like global FX strategy co-head. I don't know which one this. Let me see if like there's anything in the zero hedge stuff. JPM.
Hello.
Hello.
Hey Barnaby.
Hey guys, how's it going?
Good, good. Just a lot of earnings today.
Nice. How was Rivian?
Yo, what's up? Yeah, just got off the Rivian call. So they didn't do as strong of a pushback as I hope they do. The reason why is they just straight up pushed everything into Q3. Then Q2, the R1 Gen 2 is not really like the retooling progress doesn't fully reflect the new generation product that most of the sales done in this quarter is I think no, sorry, not most of, but all of the sales they did in Q2 was the old generation. So all of the calculation method is based on the old one. And they said Q3 is going to be a clean quarter, and you know, they're just asking us to look to Q3 for guidance. So that actually made Q3 much more important than before the earnings call. So that actually is like an additional catalyst other than the gross margin positive in Q4 that we need to look out for. So, but yeah, like it's positive on what they are doing on the gross margin side, like the variable cost improvement, the fixed cost leverage, like there's some ASP tailwind, like that's all very well. It's just about like when they'll be able to like how far can they get in Q3 for them to achieve that going Q4. Um, but yeah, they're gonna shut down factory for a month next year, so I need to revise down my production delivery target all the way from Q3 to next year.
That makes sense.
Yeah, so they actually give pretty good guidance for Q3 and Q4 delivery and production. So that's like, I think that will be priced in pretty soon. And fiscal year 2024 revenue is going to be priced in pretty soon. Yeah, but on the 2026 R2, there's some like positive dynamic about it, but yeah, I don't think I'm gonna just fully reflect that into the price target. I think it's still a little bit shaky. Um, for the 2026, but visibility improve for 2025. But let's see what the gross margin do on the Q3 number. Yeah.
Right.
So overall, I wouldn't say it increased my bull case because I think the bull case tail is further narrowed down. I don't think we'll have a guidance increase. I don't think we'll have like a really fast shift to gross margin positive. It's just gonna be trotting along, like, slowly grinding towards that goal. But the downside is, I think the downside is a little bit unknown. So I was widening the left tail is because we don't have any data yet on the R1 Gen 2 demand profile. So that, like, I wouldn't say like it's gonna be bad because like the vehicle should be pretty good from what I see on the reviews. But we just don't know like whether people are just going for the R1 discount that propped up Q2 delivery number, or is it actually people are more interested in the vehicle? So that's like a question mark. But I would say like R1's attractive vehicle, like they're probably gonna deliver their guidance. But Q3 is like the top line at least I need to revise down. Like my estimate is way too optimistic.
Right. Okay. That's I mean that's a good take. Whenever you have um, a result like this, if you know that the quarter is going to be like, this is where you have to like figure out like which quarter is a catalyst going to be in. And then, you typically want to run it a little neutral unless there's some sort of a, valuation gap that you want to exploit. So
Right.
sometimes if the market is like, just like not, understanding what's happening, then that's a little different.
Right. So I'm still running a medium beta position. So yeah, not too high conviction, not too low conviction, like right in the middle. But we'll see what the macro brings for the next few weeks. So maybe we'll have some more opportunity if vol picks up again.
Right. Nice. Yeah, across my coverage, pretty chunky day, but pretty decent. We saw Global Foundries report in the morning. Actually, was a decent result. I think we're seeing a troughing of, the broader semiconductor space. So I think that's a positive backdrop for, the broader industry going into say 2025 and 2026. But I already had a view that, we were in the beginning of like a, semiconductor cycle or an upcycle again. So all that did is really confirm that view. Fortinet reported. Barnaby, were you able to, see what happened with Fortinet there?
No, unfortunately not.
Yeah, so that was a pretty strong beat. The thing that I was really trying to pay attention to was, for Fortinet and for companies like that, more on the hardware side. So, think about like what's happening in like the network security space, for physical devices. I think there was a lot of concern that maybe like firewalls, like physical firewalls and physical networking tools probably see a little bit of a slowdown, but it looks like actually that that's not the case. So that's a positive dynamic. I don't have a position in it, and so like I was just covering it from a surveillance standpoint, but that was still good to see. I think probably the biggest, or the like most important name that I was covering today that reported was Supermicro, mainly because I have a tiny position in them, so I wasn't, I think I had like a 1% position in them, so didn't have any real conviction on what was going to happen for this quarter, mainly because there were some concerns that NVIDIA might delay the rollout of their GH200 or their Blackwell chips because of some design issue. I didn't think that was going to impact like the fiscal year, but I just wasn't sure where in the quarter that will land. Still, the thing about Supermicro is they are primarily benefiting from like hyperscale adoption. They have a unique strategic position in the server rack space business, in that they are like a leader in liquid cooling, like DLC, which is direct liquid cooling racks, which is like a fairly newly adopted technology. I mean, it's existed for decades, but it's only really been adopted with the advent of AI factories, and where you have like hyperscalers that are trying to increase the density of their GPU clusters, because DLC is just much better than air cooled CPUs, right? Because if you have an air cooled system, you could overheat, you can't run. Your devices tend to run at a higher average temperature than if you have a DLC rack. So you have like more problems with air cooled systems. So anyway, so Supermicro is like one of the few companies that has that. And so seeing, when you see Supermicro, they're like on the value chain of like a supplier of like Meta and Microsoft. And so when you see that their results are strong, then that, well, the first thing is that in the week prior, we got the CapEx data from Microsoft and Meta and Amazon, right? And those are all quite strong. So that was positive read-throughs for Supermicro. And then you want to see the result of Supermicro. The thing in their result that was interesting is they beat their guide, but they slightly missed estimates for this quarter. They said it was due to a customer. And then and they said that it wasn't that they lost sales, but that sales were just it's going to happen in the next quarter. They raised their guidance. So the estimates for 2025 was for 23 billion. Supermicro raised they provided guidance of 26 to 30 billion. So that was like a substantial, it's like a 10% plus increase over estimates. What was more interesting, though, was that their gross margins fell this quarter. So they had kind of averaged around 14% through the year, and they fell to around 11% in the last fiscal quarter. So this, I think, is like a big concern right now in the market, because within the rack space solutions groups, like, you have Supermicro, you have Dell, HP Enterprises, and then you have all of the other like OEMs. Among these firms, only Supermicro is really focused on DLC. That's direct liquid cooling. Dell just got into the space, and so last quarter when Dell reported, one of the things was they pretty much reported a boost to sales, but like flat margins. And so everyone was like, oh my God, that means that you're not going to make any money off of these new sales. And the idea was that, the concern became that maybe there's some price war that's brewing between Dell and Supermicro. When I did some expert calls. One of the expert calls I did was actually an executive at CoreWeave. And so CoreWeave is a company that actually buys a bunch of these GPUs and then leases them out to other people. This guy said that he would expect that Dell does take share from Supermicro. So that was like one thing, that maybe Dell does get some share taken. But other experts, including a guy at Dell, so someone that is an executive at Dell, or actually an ex-executive, said that Supermicro's niche is like better because Supermicro does all of the manufacturing in-house, whereas for all of the other ODMs or larger firms like, say, even Dell or Lenovo or HPE, they pretty much outsource most of the manufacturing, and they just do like the last elements of the manufacturing. And so this advantage is like a structural advantage that Supermicro has versus Adele, and others. Which is why it Supermicro has the customers that it has, which are different than the customers that Dell has. So like like my thesis is that what's happening in the space is that hyperscalers like Meta and Microsoft are buying Supermicro because they just need quick plug and play, high quality DLC rack solutions that they can use for their foundational models. Dell's business is more along enterprise data centers and maybe redeveloping, redeploying, rebuilding those those enterprise data centers. So I think that the customer mix differential means that they can both, expand and succeed in the industry, given that DLC is probably going to win share, just because of the shift from from CPU to GPU clusters. So in that environment where you have more energy demand and higher temperatures, DLC right now is just a better solution. So in this setup with existing data centers as they get retooled, or with new data centers that are getting commissioned, you will see data centers or you'll see DLC win share from air cooled systems. That's like my underlying thesis. And in that environment, you should see both. Supermicro should do well as hyperscalers continue to invest in their foundational models and need the GPUs to provide that. And also Dell can do fine because enterprise customers will also, like, once they get their inferencing stack, set up, they'll also probably move to DLC systems because the nature of the data centers is shifting from a CPU heavy to a GPU heavy one. So like, because the temperatures are rising in a data center, it just makes more sense to use DLC. You have a lower failure rate. So that means a lower cost of ownership. So, that's what enterprise customers is going to look at. And so I think that there's a compelling case for, winning a share there. From what I've seen, like surveys that I've seen, I'm not seeing any pushback against that thesis. So that holds. Now today, after the market reported, stock is down. Stock went down. First of all, the stock was like short, heavily short, and so kind of going into the print, there was always going to be some funky dynamic. Stock first rallied to 700. It was I think it closed at like 625 or something. Up to 700, and then went down to like 530. When I was like going through the different scenarios, so like my scenarios, when I'm looking at the stock, I'm looking at, well, what are they actually pricing for next year? The thing with Supermicro is it trades out of PE because, it has pretty visible earnings. And even though the margins are quite noisy because of the nature of their capital intensity, that's how the stock is going to trade, because it's a low margin business. So it's not like a software business where like, oh, I can just cut SG&A and turn on a switch and I can generate, EBIT. For Supermicro, it really boils down to like their pricing power, which is tough. So for Supermicro though, given say like the midpoint of guide, so this is my numbers. I was like, okay, well, the midpoint of guide would be about 28 billion for next year. They mentioned on the call that they're working towards a margin improvement plan to get margins back up to between 14 and 17%. So I took the midpoint of that, 15%. Their net income tracks about 2% below, or 2 points below that. So I'm saying, okay, well, I'll do 3 points below that. Net income of say 12%. That gets me to like $57 of earnings next year. When I looked at the multiple, it typically trades between a 6 to 10 point spread over Dell. And given SMCI's positioning, the boosted guide, it's slightly the slightly better margin profile, I'd lift that to like 8 points. Dell was trading down to like 11 times. And so I'm like, okay, well, Supermicro can trade at between 18 and 19 times. Then that makes sense. If I price it on at 18 times PE, that gets me to 1,025. Okay, so like that's the price target. That would be like my that is like the guide case scenario for. That's not even my bull case. That's just the guide case scenario for Supermicro. Even if I take a more conservative PE, I still get to around $855 NTM. Okay. Now, the two key concerns were, one was the liquidity concern, which is like, will Dell need to raise more capital? And if they raise more capital, or sorry, well, Supermicro needs to raise more capital. And if they need to raise more capital, well, they need to do it via stock issuance or via credit. Well, on the call, the CFO mentioned that they currently have a 500. And we found this out last quarter. They have a $500 million credit line with B of A, and he said, and like I could tell that he was like couldn't say more. Like he was gonna say more, but like he couldn't. He said there's gonna be more loan opportunities that they're gonna discuss in the future. So that tells you that like they're working on non-dilutive deals to get their financing in line. Okay, so that's the Supermicro situation. For me, that means that the downside thesis of a cap raise, like them having to issue more shares, that thesis is broken. So then ultimately, what it boils down to is, on the call, you hear the Q&A, and there's like, typically guys on the, or equity research analysts on the call, like the first thing they say is like, oh, great quarter, or blah, blah, blah. And they're like, congratulate the CEO. In this case, it's not like that at all. The guys were like, the sell-side analysts were like, so what's in your guide? Or like, tell me about the visibility in your guide. They were very skeptical of, it seems like they were very skeptical of Supermicro's guide. I think the primary concern, their skepticism boils down to this like price war concern, which is that Dell might be winning share versus Supermicro. Supermicro's guide might be based upon the view of a market share retention that maybe the sell side is skeptical of. So I think that ultimately boils it down. So what I did was I said, well, okay, so my downside case is if you expect that there will be a big miss the guide. So if guide is between 26 and 30 billion, I'm saying, okay, a 25 billion, okay, sales estimate, and a margin of 9%, which is the same as today, you get around $38.50. That's EPS. Typically, when the margins are a concern, stock traded around 13.5 times, so that gets you to like 520 on the price target. So when I look at the stock price today, it's like 540, it hit 540, was below that at one point. I think it's at 547 now. That tells you that's what the market is pricing in. It's really pricing in. It's a scenario where like you get a miss to guide. The guide is too high, and then margins are a concern. If multiples stabilize, though, you could get the stock even on a guide miss to like 670. So this is like the dynamic that I think is taking place. Now, another big problem that I observed on the call was there was a lot of disconnect between the questioners, the analysts, and the CEO. Like there would be a question and the CEO just wouldn't understand the question, and when he would respond, it would be like in a different way, and vice versa. Things that he was saying were just not being understood. So it's kind of interesting, to like see this still be the case. And so where do we go from here? Well, this was a big quarter because it's the Q4 quarter. So guide I think is important. I think the right way to understand, I have no reason to shift my view of what I think is happening across the industry, which is that Supermicro and Dell have a different type of client cohort, and that therefore the price war concern might be a little overstated. That's my view. So in that scenario, I think that there is I'm willing to take the management's guide. I'll take that. I'll take the lower end of guide and run with it, and I think that gets us to over $800 a share. So I'm actually pretty constructive on the name. Will I buy it tomorrow or will I buy it today? That's a tough question. I think I'm going to want to take a look at the calendar. So I'm going to want, so Dell, so in about 2 weeks, we're going to get, Dell by the end of, we have Dell and HPE towards the end of the month. I think that's the next catalyst for Supermicro. And so I think that between now and then, there's going to be some, some choppiness. So I think I would tactically, buy a little and just work through my earnings preview of Dell first. And then depending on where I think, what my earnings preview on Dell is, I think that would ultimately tell me if I do want to actually go long here. Technically speaking, though, I mean, based upon what the management actually provided for, which was a better margin outlook, like this is the actual takeaway: better margin outlook, much higher revenue outlook. So, this is a long trade. I would say I would definitely. I think that I like the beta of SMCI here. The question is more to do with like, is the AI thesis still getting, derailed or whatever? I mean, we have NVIDIA, that's going to report, also later in the month. So I mean, that will be, I think, like a major catalyst. But given the fact that, NVIDIA is up today off of SMCI's news, well, I think it was up today anyway, but, it's, positive. I think it's just like indicative of the fact that there's still, ample demand for the AI, thesis. There's definitely a lot of crowding that's been in, but if you take a look at the multiples of these names, you will be shocked because you're going to see that the multiples have come down substantially over the past 2 months. So I'm actually like my, I don't want to call it like my trade idea, but like a trade that I'm thinking of is like, because I'm slightly, I'm still kind of neutral or bearish at the index level. I think this is a great pair to make, which is like, yeah, I'd go a little, I'd increase my net on these AI hardware names, probably decrease my net on software names, just because I think that software is still kind of in a funk, still a little cyclical. So that's kind of my take on earnings today. There were a couple of other names too, but I haven't finished wrapping up my notes, so probably have some stuff that I'll share later today. What about you guys? Anything that you guys wanted to share and discuss?
I can add some info to your Dell read if you like.
Yeah, sure.
Being ex-Dell myself, it's a company I track pretty closely. So, are you familiar with Dell DCS?
Yes.
Okay. So the DCS is the data center solutions group within the infrastructure group, and it's not, they don't report to it, but like what DCS does basically is customized solutions for for 3 bids and a buy, like for these mid-market data centers, and it's very, very directly competitive with Supermicro. So Dell, the perception that Dell is a preferred enterprise brand is accurate, except the perception that they don't compete directly with Supermicro, or that Supermicro has a leg up in sort of these tier 2 data centers is not, right? Because basically in every deal that Supermicro would be in, DCS is in, right? And they can be very aggressive, just as aggressive on price, if not more so in some cases. So I think that the competitive element there is quite real. It is softened somewhat by right now Dell's networking portfolio, for example, is lagging behind. And so what I mean is, like, since the infrastructure spending we're talking about is primarily driven by the AI use case. Pretty much all that spending is on the network side directed towards like 800 gigabit Ethernet, and Dell doesn't yet have a solution in market there, whereas Arista does, right? So like normally, if it's apples to apples, right, Dell often gets an edge in these deals because they're offering an integrated or pre-integrated solution, and so you have one vendor to deal with and one source of support, and because of that, they're getting different margin in different pieces of that infrastructure footprint, and they can be a lot more aggressive in the deals. So I think that's somewhat mitigated right now because of this dynamic that like Arista is the lead in market with all the AI networking, but particularly with 800G, and that's likely to persist for a few more quarters. I haven't heard anything recent, though I keep looking. I could be missing it, but I keep looking for Dell to introduce or talk about introducing its 800G, and so far I've only found like rumors of it like buried deep in the website. So I haven't seen anything, really like a product launch in that regard just yet. But Dell networking people don't kill me if I missed it, because I keep looking. So anyway, I thought I would add that as some additional dynamic. Like, I think the competitive thing is very real. Vis-a-vis Dell and DCS.
Right, and I think that's a good point. But I think more of like so if you think about like some specific customers, like say CoreWeave or Meta, or Microsoft. I'm not saying that DCS or Dell won't try to compete with Supermicro here, but there's a couple of competitive advantages that Supermicro has over Dell in a match in a head to head in a bake off, for those specific customers, and those are that Dell is not fully integrated. Supermicro is fully integrated. So what that means is that Supermicro is controlling the process from start to finish. It's a very modular design business. There's no outsourcing. They're not using any ODM or OEM. They're completely manufacturing and doing the assembly in-house themselves. The thing about this that gives them a leg up is, even though say like when NVIDIA or AMD came out with a new chip, Dell and Supermicro would get them both at the same time. The difference is that Supermicro would have the racks ahead of time because they are manufacturing them in-house, and they can just, they're based in San Jose, they'll just walk over to Meta, like literally, and hand them the rack. So when I spoke to like the CoreWeave guy about this, that was like a key differentiator, which was the time to market is a good enough, competitive advantage. The other thing is that Dell has limited history in the DLC space. There is some concern that DLC is less efficient than air-cooled systems, than ACS. But Supermicro's DLC is the gold standard. So Dell is going to have to like get some product parity there, and that's just going to take some time. So I agree that Dell is very competitive in the space, and personally, that's why I think that they both can win. What I think that they're winning against is not really against each other. It's against like your ODMs in Taiwan and in China, like Hanhai or Waiwen or those names. I think are the ones that will potentially lose share here because most of the spend here, at least with these guys, are going to be for enterprise, for customers, that really care about that, like niche focus. Now, at the end of the day, SMCI is quite small compared to, the volumes that those other guys do, right? And that's another reason why I think that SMCI can continue to benefit, because it doesn't need to be like a Dell or HPE. It just needs to continue doing what it's doing, and it'll be able to, maintain itself. But yeah, I think this is more a story about how Taiwanese ODMs and Chinese ODMs will lose share versus Supermicro, Dell, and HPE. You know, in this period of time. Now, will that eventually catch up? You know, maybe. Depends on tariffs and trade issues and other things, right? But I think I think right now it's enough an advantage that you can see this persist.
Yeah, the two major, like, at the hyperscale side are Quanta and Foxconn, right? I mean, that's, we talk about the contract manufacturers uh, putting these systems together. It's mostly those two. So I like both long as a trade idea. Like, I like both long Supermicro and Dell. I'm much more pessimistic on HPE. Like, they just, from a product standpoint. The other one that's kind of a question mark for me right now has been Nutanix. And the Nutanix says, like, Nutanix is known for their, pre-integrated and systems like converged infrastructure, which was pretty important, like in the era of virtualization and consolidation. And they've struggled a little bit with that in recent years, and have tried to pivot to becoming more of a software company and selling the Nutanix stack, to a set of enabled hardware. And I think they could be kind of like a sleeper in this, because they haven't quite got their AI story straight. Let's put it that way, for the sake of time. But that's another one that I think, particularly in the mid market, could do okay in kind of the next two quarters. But yeah, I guess, long Dell, Supermicro, short HPE. I kind of like.
Yeah. Interesting about Nutanix. So I cover Nutanix, and we were long. We traded them up to like 80, around 80, and then sold, and then recently started to like nibble in again. No, I like them. I think that so my thesis on Nutanix, like, or my beta view on Nutanix, is that what we're seeing happening is cloud consumption continues to grow, but the marginal growth is being driven by AI spend. Public cloud costs are very expensive, and that is pushing. Enterprise was already on a trend like before COVID to go multi-cloud, and even a resurgence of on-prem. And so as this trend persists, you're going to need more multi-cloud, like an OS, right? And that's really something that Nutanix does very well with their virtualization. Obviously, they're like second tier to VMware, but with the recent Broadcom acquisition of VMware and VMware kicking off a bunch of customers, right? That was like the tailwind for Nutanix to really benefit from.
That's right.
So that's kind of, I like them because I see them as benefiting from that environment. Now, another thing that I like about them is that I believe, so one of a key player in this like weird, say, multi-cloud shift is you have Oracle on one side, and then you have IBM on the other side. And one of the things that IBM is figuring out, that like it kind of knows that this is what's happening, but like it's not yet going all in yet. But this is becoming this is going to be one of the largest segments. It's doubling every quarter. Is their AI consulting business, because they have like a ton of legacy enterprise customers. And so they're like the enabler for those customers to adopt AI. And, before IBM had Watson, which, for all of their research, was just ended up being a little bit of a gimmick. But the thing is, they've integrated with like Llama 3 and all of the other open source LLMs. And so what they're doing now is they're saying, hey guys, like, they're going to their customers and they're saying, we can help you deploy the leading foundational models on your own servers that you already run and have. And if you need more stuff, we can help you figure that out. And when they're doing that, their OS, the virtualization layer that they're using, is Nutanix. So this to me is a really strong tailwind, I think, for Nutanix that'll benefit them. The question is like, when does this really begin to pick up? For IBM's AI consulting business it's already a $2 billion business. It's been doubling like literally every quarter since they started it a year and a half ago. It's actually the reason why we've been long IBM. It's kind of like a sleeper trade in that sense. I don't think enough people know about the story, and I think management also has not like they're not like they have been screaming AI for so long that people have kind of like tuned IBM out. But I think that as this gains traction, you'll start to see this positive impact in Nutanix around Q1 of next year. And that roughly aligns with our timeline for like broader like enterprise adoption or like, say enterprise enablement, of AI. So yeah, I like Nutanix. I think you can go back up to, $70, $80, a share, and trading at like 46 right now. So quite a discount.
Yeah, I actually, I actually particularly like it at this price. Because I also see a lot of upside to it. I see like, yeah, 70, 73, 70, would not be out of the question at all. Even higher. But I think it'll probably, I'll probably start to buy it. I'm almost completely flat over here because of the market dynamics, and I monetize my hedges, and so that sort of left me staring at the screen. And there's stuff to buy everywhere, of course. It's just really a question of whether or not this recession is going to persist or not. And so I was kind of waiting for more macro data to come in this week, and eyeball it, take a look. You can't,
this is a good pivot to a macro discussion, so that's good. Nice.
Good segue if we haven't done macro yet. Anyone else got any earnings related stuff?
I think we're through the earnings stuff. Maybe we'll get back to it, but let's go ahead and move on to macro. Yefeng, you want to give us, or Yefeng, Andy, you guys want to kick us off and speak some macro to us?
Yefeng can go ahead and start.
All right. So obviously, like during the weekend, there's like some turmoil in Japan's territory. Like, I mean, like people are saying this is like a carry trade unwind. I mean, and we like the Nikkei kind of like fall off like a cliff, but it like rebounded for like half of the move on the second day. Yeah. So overall, I mean, like we did like experience like very high volatility starting from this week, but I still think this is kind of like, well, I mean, it all started like locally in Japan, where like it's more of like a, I mean, what I'm trying to say is, this is like not kind of like a recession imminent scenario where like, I mean, I still remember on Monday people are discussing about like emergency cuts, like the Fed watch is pricing something like a under like 20 bips of cut. I mean, like people are just like going
People
crazy.
legit panicking. Yeah.
But I think this is like an overreaction. I mean, I was like checking the Atlanta like GDP nowcast and as well as the NYF GDP nowcast for Q3. I mean, right now, I think just like today's new number for like Atlanta GDP nowcast is still like 2.9%. And like the NYF is at like 2.11%. So the nowcast are still like projecting like a 2% GDP growth. And as of the close today, the 2-year is like almost like 4. It's like 3.992. I think the entire curve like just like shifted upwards by like 13 bips. It's like a translational move. There's like no twisting, like no curve changing. It's just like a translational shift. Like everything just went up by 13 bips. Like the 210s. I mean, at one point it almost like went positive, but right now it's still like maintaining the level at around like -9. So we're still like a little bit like inverted in like 210s. But yeah, it seems like the bull steepening is just still going. Um, yeah, the ISM services like went in like pretty strong. Um, yeah, so I mean overall it seems like apart from like this like carry unwind scare and like people are reacting into like somewhat like a growth scare, but like the incoming data are still not like vindicating like this kind of move. I mean, I was like browsing like Twitter when like you guys were talking about the SMCI and like Dell, and I came across like Anna Wong's posts, like the Bloomberg economist, who was like arguing like the labor market headline figures are kind of like bloated. And she's kind of like applying the she's trying to like revise the number with the birth death model and the other like home-based data. And she's been advocating that the labor market is like weaker as it seems. And today, like she posted something that like the GDPs are like also bloated because uh she was like basically referring to like a 2001 recession, like how the first quarter GDP is kind of like revised from like +2% to like -1.3%. I mean, yeah, I mean, just like people are still like advocating for a like a larger rate cut. It's like trying to tell Fed that you're behind the curve, but we'll see. I mean, right now, I mean, the data is still like not. I mean, it's certainly like weakening, but it's still like not kind of like recession-like. Yeah. So yeah, we'll see. Like, I think today, like I saw, like people are mentioning like the carry on wine is still probably like not completely done. There's still like some positioning like in Japanese markets. So yeah, and I also like the vol like rising so fast. I mean, that might trigger like some low targeting fund to kind of like degrowth. I mean, certainly you will have like a smaller position when the VIX is at 30 compared to like VIX is at 15. I mean, all of these are kind of like, uh, I would say just like positional move, but like the underlying, like the macro backdrop, I mean, at least like for now, it still seems like resilient. It's not like everything's like falling off the cliff. Um, yeah, so I mean, this week, I mean, there's rather like light in like economic reporting. I mean, next week we'll get like the CPI, and yeah, next week we'll also have like the state wage and employment, and also like on August 21st there will be the QCEW, like the quarterly like the wage and employment data, and then we have like Jackson Hole. So yeah, I mean there are actually like a few labor market prints in the incoming weeks, so we'll probably get like more confirmation on whether like labor market is still like just hanging on, cooling down, but like still hanging on, or it's like kind of like weakening. I mean, it's like weaker than like everyone thought, and that will probably like trigger like a another reaction in the rate markets. But for now, it's just like today, it's just like rates the yield's like going up a little bit. Yeah, the steepener is like just like there. I mean, kind of like almost like uninverted, but it's now like still a little bit like inverted. And I think probably like see like more steepening in the future. Um, yeah, I mean, if you guys like see anything else, I love to hear it. But I mean, beside that, I'm just like fighting with like the Refinitiv like options data feed. Uh, yeah, I mean they do have like a pretty comprehensive like time and sales data. So like not only you can get the like the open interest and the volume, you can actually like tag trades where like some people like dump or like traded like 250 like Apple contract. You can actually see that, but right now like the metadata is like incorrect. I mean, I've been like reflecting this issue to them like starting from Monday, and I just like provided like plenty of evidence, and they seem to like realize like something's wrong, and they're kind of like fix it by like August 24th. So we'll probably like need to wait a little bit, but I'll try to like compile like the positioning on like SPX, so that will include SPX, of course, and then there's like the SPY, the ETF, and probably like also the uh, like the options market on ES. And there's still like a lot of volume trading on the futures contract. I think that will provide a more comprehensive positioning overall, like on the S&P. And I think that's probably like very helpful for us to determine like where is probably like the hotspot. Yeah. So I'm just like loosely following on the like the macro development because I mean there's like really not like a lot of like new development. Like people are just like panicking over like the huge like wall move, like the price movements. But I think the overall macro backdrop, we're still not like receiving enough like new. I mean, just like according to like most like nomenclature, is just like no like significant incremental information coming in right now. So yeah and so like in the meantime, I'll just like work on the attack stuff. So yeah.
Right, so yeah, thank you, Yefan, for a very quick recap on what's going on and look forward to what's gonna come. So for me, actually, I would say like I view this whole event as a whole. Like let's look at it on a week basis. Like from last Tuesday to now, like are we in a better position or not? I would say we are. Um, why? Because okay, so first of all, you had BOJ Fed last week, middle of the week. Fed is pivoting a little bit towards the cutting in September and then the further cuts that's gonna come, and then BOJ hiked rates and signaled there might be more hawkishness on the way. And as we move towards a weekend, we got that NFP print, like anyone said, it's going to be, probably we're looking at a negative number, right? If we are, accounting for the birth death model, and then U rate go up to 4.3%. So that's how we ended last week. And now during the weekend, there were a couple of risks. One's geopol, right, in Middle East. And we had Berkshire Hathaway saying dumping 50% of the Apple stocks. And yeah, and then the Japan carry trade kind of just happened during, I think, dinner time for us on Sunday. So I actually talked to the Asia trading desk of my old friend, and they're like, it's absolutely crazy. There's no liquidity anywhere, and they're triggering stop losses. In some places, they're triggering not stop losses, the trading limits, and there's trading halt. And when they find nothing they can do on the future side, they started like shorting everything they see on the screen. So that was the reaction over there. And you saw the Bitcoin jumped down, and then the Ethereum, they all went down, right? It was a panic moment when there's no liquidity in the market, there's market structure failing, and people just and it's Asia trading hour, right? So you don't have London's not in yet, so you don't have London liquidity, which is the biggest thing in the world on the FX side, and then US is like 12 hours away from opening, so like that's not in there, so you're operating in a limited liquidity environment. And one thing I would like to add on the carry trade, or like on the general dollar yen move, is that I do have read-throughs of Japanese companies in my coverage. I brushed through their earnings notes, and I realized that they've been saying, okay, so we got Q1, Q2 sales growth because we have favorable, FX tailwind. And what's key is in their guidance, they actually said we expect this FX tailwind to continue. So all of these corporates in their guidance saying we expect dollar yen to keep weakening, and that will prop up our earnings. And we can see in the Japanese stock market, as soon as that flipped, all of that thesis, just like anyone with that thesis, doesn't matter you're on sell side or buy side, needs to dump it, right? So that thesis is no longer intact. You actually need to look at, okay, so now the dollar yen is actually reversed. What is the impact on the earnings for the domestic companies? And hence you saw that big topic sell-off, which to me, that reason is enough plus liquidity. And then moved on to Monday. The stock market actually sold off a little. Like, I mean, it's a continuation of the futures, so it was out of place. But in my coverage, everything kind of moved back to where they were trading a Friday close, relatively like 30 minutes or 60 minutes into the trading session yesterday. I don't know if you guys have the same experience or not, but maybe not the mega caps. So like if these macro events or these things happening in other markets does not have a direct impact on the company earnings in my coverage, then I took that as an opportunity to pick up some shares cheap, and ramping up some position that I want to pick up. So like Tesla, for example, right? I picked up some shares around like 180 regions, which is James, like we discussed, I think a week before, it's like a range where we would like to take a look. So I took that as an opportunity, and today another session with people focusing more on the earnings side with a catalyst light calendar. So yeah, like I highly recommend most lists of things to watch in the chat. So that's really helpful. But one thing that I noticed is the magnitude of the move and how quickly things deteriorate is not something I see often. Like, even though if I look in history, it's not something that um, that's been like it's not common in history, right? And then the way the VIX move.
Let's kind of like just like walk through like what's happening. Like on Friday we have like the NFP, right?
Yeah.
And that kind of like, I mean, at that point there's like the New York hours, like I mean Japan is already closed. So you suddenly get like a weaker than expected labor market data print. So I think that's starting to like trigger the dollar yen move. And I think like the Sunday's like night move is more like a continuation of this, and because like the dollar yen has already like moved by quite a lot, and then it starts like triggering like, well, like you said, there's like margin issues, right? So I think this is like more of like a I mean, just like everyone's like having too much leverage. I mean, there's something I've read like about like I mean, some of the people are monitoring the swap spread. So it's like the what's like the U.S. like Treasury swap, like the difference between like a swap, like an interest rate swap, and like the like the bond itself. I mean, so that swap spread is like deteriorating really fast, which means like I mean, just people are kind of like over leveraged. So I mean, that's probably like why, especially like after like Japan closed, we got the dollar yen move after the MFP print. I mean, that's kind of like you have triggering like the leverage limit, and that's kind of like triggering the deleveraging or like the degrossing. So like everything just move like in a such like uh just like magnified way. So I mean, that's something like probably like contributing to like very fast, like I've never seen like something moving so fast.
I
I
think
mean, even
COVID thing was fast, but I don't think when we have like '08 or the dot-com bubble we had, like I didn't live through those. I mean, I lived through those time, but I wasn't paying attention to the market. But I didn't know whether it was the same kind of panic or magnitude of move, or it's much slower grind, um, of decline. And obviously the where I want to land at with this comment is actually like how crowded these trades are on the carry trade. Like since I was doing sales and trading, we had those like huge dollar yen rolls. It's just because the long only side they were in this carry trade. They're super big, like billions of dollars in these positions. And Yeah, so I was like, is it time where we need to look at whether trades are too crowded when everyone's on the same side? And then for those, should we be more careful even though there's like there's an ideo upside, even there's an ideo upside, or even though the fundamental makes sense, should we be more careful around those trades?
upsiding what then? I mean, just in risk or like in equities or like in FX or what's like the
I
upside
think
here?
in all of these trades, right, when you have
Or you just mean
fundamental,
like the very general
yeah,
like risk on
yeah,
trade?
like I wouldn't call it risk on trade. It's when a trade is being known by most people on the street and it's very popular, it's making money. Should we be more careful around those trades? Like that's what I've been thinking since Sunday. Is is there anything we can do on our level
I
that
mean,
can manage this kind of volatility better?
just like
And
there's like if you like read the books like The Rise of Carry, I think that's where like people are kind of like discussing like some characteristic of these carry trade have in common. Like I mean, they always like share something with like a short ball return profile basically, or like a risk profile as like a short ball trade. So I mean, even like today, we're still seeing like people like the JP Morgan head of FX or like the co-head of like global FX strategy saying the carry trade unwind of the dollar yen part is still not finished. And that's just
right.
tell you like how like over leveraged like everyone is. I
Well,
think
I
like
mean,
right,
if like it says it's like 40% done or like there's 60% left,
yeah, I
right?
mean there's like
But we already moved back, let's say 40%, and can the market take the rest? Can the interest rate differential and the transaction cost justify for that cost? And when the trade doesn't get as crowded as before, as stretched as before, is it going to be a more manageable situation?
well then it really depends on like the vol level. That's my
Right.
view. Like because mostly like the positioning is connected to like the volatility. I do think like people are even for like carry trade like there's also like a vol targeting component will kind of like determine like how much you can put on the trade. So yeah, I mean, just like in my view, like I think Mo also mentioned this, like the vol tend to cluster, right? I mean, that's kind of like one of the I mean, it's mean reverting, but it's also like likes to cluster. So I think this will like stay volatile for a while, and in the meantime, like the maintained like a rather elevated level of like vol, just like keep people from like just the growth, lighten your position, decrease your leverage. So yeah, I think this probably like will still last for a while until like whatever like the margin or leverage like something like is like within the line, and then I think that's probably like when we'll be able to stop. But I do think if like Evolve just like tend to cluster, we'll still like have at least like a week for like 2 weeks. I mean, unless there's like incremental information that tells us like, okay, like the slowdown is probably like exaggerated. Actually, like economy is still like resilient. Water is still like not full of piranhas. Like it's still like just calm water just come in. I mean, we probably like need some more incremental information. But before those information kind of like it gets printed or like gets on the wire and just like to remain the status quo, I mean, then the elevated like vol will just stay for a while, and I think that's just gonna like keep people like doing their like whatever they're doing, like the grossing, the leveraging, just whatever, just to like decrease the risk. I think that's probably like right now the theme until like something just like more incremental information. I mean, that's just my view.
Yeah, yeah. I mean, I'll yeah, I agree with that, but like, okay, let me finish my view really quickly. I know like James and Mo are like desperate to have a go. But like, why I think we're in a better position. I spoke with Mo briefly yesterday about this was because I think that we bleeded the radiator a little bit, so the pressure is lower in the pan. And we will have a much worse situation if we have a sudden twist in September and then the August data was still fine. And if now we have this weaker data, people are readjusting their expectation and going to September, where we think is where most bearish economic data is clustered around, there will be less of a surprise, and therefore, I'm still agree with Mo that bearish on like the index level, going to the Q3 and Q4, and but it's good that we realize this first, and then we'll like pull forward the contraction or like slowdown and set up more cleanly for 2025. So that's my view. And let's pass over to Mo James.
Yeah, I'm just gonna add. I mean, there's like
Sure.
a book called like the second leg down, so I'm gonna wait for that to manifest itself and then just consider like the possible recovery. But yeah,
The deputy dip.
there will be always like a second leg down, so just gonna wait for it.
Who's going next?
And Mo's still muted. Oh, okay.
Gene, Hunter, you guys want to chime in? Anything you guys wanted to add or bring forward?
Yeah, I mean the focus obviously from the press was on the Japan situation, but we also got some macro data. The PMIs have been rolling out. There was some correlation with the manufacturing PMIs looked really bad, and so I think there was a read through to that a bit. The U.S. services PMI looked really good, much stronger than I suspected, but globally the PMIs still point towards contraction. So we're still at a global level, still in growth, but we have the second month of declines. I noted also in the the 21 sectors I track that last month all those sectors reported strong growth, and 5 of those sectors slipped into contraction this time. So that was kind of I expected it because that's what tends to happen is it tends to peak in moments like that, and then you see a pullback. um, I think going back to my last newsletter, I'm about to push the next one, but my view hasn't really changed. I think of the 21 sectors I track, 21 of them reported price inputs increases, and 19 of them reported output increases. So I still think inflation is in play. M2 is up. So I think we're slightly stagflationary, and certainly there's a deflationary risk. I mean, I think that is ostensibly what the Fed wants, right? We want deflation, and so I think that risk is still very much in play. I don't see a lot of evidence that there's been a lot of rumbling in the media, like that we're setting up for a 1987 style crash, and the market will be down 60-70%. Right now, it looks to me like sort of a shallow recession. So I don't see any evidence that confirms the case that we're going to have a super deep recession or anything like that, or even a prolonged recession. My view is that we are slightly in recession. SOM rule was also triggered on Friday. That did make the press for a minute there before Japan took over, I think. But just barely. The SOM rule just ticked above its minimum recession threshold, and I think SOM herself came out and said that she didn't think that we're in recession, but we're really close to it. So I don't know if that's just her doing a solid for her friends at the Fed, or that's her conviction. But I think she came out and said that yesterday or today. So one other note is that month over month, 3 months in a row, there's been strengthening in new orders and output for software and software services. So that's a pretty good reversal from where we were, and so that indicates that maybe might see some strength come back into software stocks. Equipment like electronic equipment, other than servers, is thoroughly contracting right now, and that's a 3 or 4 month trend as well. So I am looking for, and I have a bunch of, I think 36. I'm up to 36 issues in my coverage now, and 100% of them almost are fully negative momentum, as you would expect. So I'm looking for some evidence that we're basing here in the market. Technically, I've been bitten too many times in this. I mean, you mentioned you haven't really seen things move this fast before. I definitely have. You never forget your first time. My first time I think was April 2001 or something like that, when the market was selling so viciously. My trading terminal froze, and the broker wouldn't pick up the phone, and on and on. The usual bit, right? Since then, there's been a few more like this. Most recently would have been the flash crash, I guess. Going back a couple of years. But this is definitely, I mean, well, and then COVID, of course, but this is definitely like COVID, COVID style dislocation. But I'm starting to develop the opinion that we're going to kind of flatline here and then go up. If we saw a really sharp rally from this level, I'd probably short it a little bit, but I kind of want to see some basing in the market before I get really committed to the names that I'm watching, especially on the software side. Those are my comments.
Pretty solid. Not so much to really add on from what you guys were talking about. I think for me, I just want to like look forward and think about what's actually happening in the market. Yeah, there was the dislocation that happened with the yen. There were there was a vol effect, of course. But for me, I like to focus on these things from like a ideo and fundamental standpoint. So, what does that actually mean from our perspective? Just kind of go through this. So, this is interest rate probabilities. We see that today, as of right now, for December, market is pricing in about 4.3 cuts by the end of the year, right? So if you think about every cut is 25 basis points, so 4 cuts would be 100 basis points of cuts. And so what we're seeing is the market pricing in more than that by the end of the year. So you think about 3 meetings. What's the distribution of that going to look like? It looks like the market is expecting like a 50 plus 25 plus 25, or one of the 25s could potentially be a 50. Right? So this is the kind of scenario that we're dealing with. I think what's really important and like the real signal here is that the regime has shifted. The 2 regimes have shifted. That's really important. The first regime was the monetary policy regime, where Fed at the where Jerome Powell at the FOMC press release at press conference said that we're now moving from a 0 cuts to 2 cut regime to a 2 cut to 3 plus cut regime. So that was number 1. That happened on Wednesday of last week. And then on Friday we had that really weak non-farm payrolls number. And the whole thing about the weak payrolls number is that what it looked like was, we've already seen that the data has come in. I can say labor market data has been cooling for some time, since the first quarter of the year. Inflation had, for a brief period in Q1, it looked like it was hot, but now it's back on a disinflationary trend. And so in this environment, the question is like, why wouldn't the Fed have cut in July? And I think that this was a question that I asked like a couple of weeks ago, which was, outside of this like anchoring, right? If the Fed didn't pivot in June, didn't do that hawkish pivot in June, the Fed would have cut in July. It's just the fact that they had behaviorally gotten themselves, I think, tied, into a hole where they couldn't, make a cut. But I would expect that, in hindsight, they may have thought that, oh, maybe we should, cut. And the reason why is because it's all about the beverage curve, right? That what we know in economic history is that once the unemployment rate starts to slide, it just begins to accelerate. And so if that, we already saw, labor market data slow. And then now if we're actually on the sliding part, then what that means is there's going to be another month and a half, and we could get a much worse data prints. In fact, I'm anticipating a really weak September report. And I think that because of the new data, previously my view was that the September report could push us up to 4.2, 4.3. Now, because we're already there, now, September can push us up to 4.4, 4.5. Right? So this acceleration in the unemployment rate is just going to get worse. Why do I have a negative view on the September non-farm payrolls report, which just covers August? It really boils down to a couple of things that I've been hyper-focused on over the past 2 months. What this boils down to is, where in the labor market is there weakness that's not been displayed yet? Like, where would you have expected to see some weakness, but it's not showing up yet? The 2 primary areas that are, by the way, interest rate sensitive are residential construction for home building and auto workers, people that work on auto plants and down the value chain. So those were the 2 areas that I thought, okay, if there was anything that's going to really trigger that a faster acceleration in the unemployment rate, it would be those 2 things. And my expectation was that it would trigger the Sam's rule in September. So obviously this got pulled forward. But the thing that was very noticeable in August was that what impacted the August payrolls was not the factors that I thought were going to impact it in September. So I just want to show a couple of things. So yeah, the PMIs that we just had, manufacturing looked really weak. Services looked better, right? It beat to the upside. Key thing here, okay, I'm gonna just highlight a couple of key things, okay? Now, it's really important to understand how the isms, how they track to the economy, right? So NAICS, which is North America Industry Classification Standards, was set up when United States, Mexico, and Canada joined the NAFTA. It doesn't perfectly track the economy, but what happens is it splits up the economy into like 22 different like headline sectors. And so one of the sectors is manufacturing. That gets its own report, okay, which is what this one is. And then it has then the non-manufacturing, so the ISM then has non-manufacturing, which is all of the other headline sectors. Within those sectors, there are like subsectors, and those get rolled up here. So so in residential construction, for example, that doesn't show up in manufacturing. Construction as a headline shows up in services, but an important distinction in construction is that it includes all construction. And one of the things that we know that's driving that headline construction number higher is the construction of new data centers and new factories because of IRA, right, which was the Inflation Reduction Act and the CHIPS Act and other, say, Biden, policy measures that have taken place over the last 1 or 2 years. So that has driven non-residential construction. That's obfuscating the construction headline in the services PMI. So if I want to know what's actually happening, like from a leading standpoint in the residential side, right? Well, residential fits under construction, which fits under which fits under services PMI. But in the manufacturing side, we get wood products. Wood products are components for home building. These are like, wood panels, windows, doors, so on and so forth. And so all of my like survey data, I speak to developers, across the country. I do a short survey with them. The feedback that I'm getting is, money is too tight. Okay, the cost of money is too high. All of the projects that we've built on were because we got all of our permits approved like 2 or 3 years ago after COVID. And so we just wanted to complete those and put those on the market. But now it costs too much money to actually build out a new project. And so what's happening with their pipeline is their backlog is diminishing, and they have like land and they're working through permitting processes, but they're not building. Okay. So this is a very important takeaway, and you can glean this actually on the manufacturing PMI by looking at the comment for wood products. If you scroll through the subcomponents, you'll actually see that on the new orders front, wood products, it was like neutral, for the quarter. But if you look at the employment, you'll see that it's one of the 13 of the industries reported decrease in employment, and the wood products is one of them. So that what tracks is residential construction. We should see a deterioration in residential construction. Okay. The other big one was, the auto production industry and the downstream effect. In manufacturing PMI, that's the transportation equipment subindex. So if you look at employment for that, it's the lowest ranked one, right? So it's like clearly there's an employment headwind to people that work in the transportation equipment industry, auto OEMs. I've been asking Andy, hey Andy, like anything that you see about any OEM talking about production headwinds or layoffs, like let me know, keep your eyes on it. And in fact, sure enough, we've seen plenty of commentary around that with Ford and GM reporting, diminishing certain production items, and then Stellantis as well with a major layoff announced. So these are the kinds of headwinds that are going to drive, in my view, are going to actually cause a surprise in the September print, for August. So that's the thing that I think that's going to be like a little bit of a, it's going to cause, quite a bit of an impact. So this is like a key catalyst.
For this print, it's still fine on the motor vehicle side.
Right, exactly.
So that hasn't impact yet, even though we have the lower NFP.
Right, exactly.
Yeah.
So for me, it's like, okay, I thought that unemployment was weak. We already had the view that employment was weak. We already had a view that the unemployment rate was rising. We already had a view that the Fed was ultimately going to have to cut way more times than 2 times, in the year. And we're on track the worrisome sign, or the worrisome thing, is that July came in so weak. Okay, so the worrisome thing is that I thought that this is going to be the catalyst for a surprise, and in fact, the market, I mean, so July came in, a lot, much more weaker than expected, and so what this means is that we might already be further down the beverage curve than anticipated. Here's an important facet for us to think about, which is, how does this economic data impact the marginal positioning of large asset managers? Think about like BlackRock or like Merrill Lynch, right? Or UBS, wealth management division, or GSAM, right? Or any of these major asset allocators. Well, if the economic regime is shifting, they're going to adjust their asset allocation. Does this asset allocation shift happen in one day? No, it doesn't. No one is gonna make some calls and strip out portfolios over a day. It takes weeks and months, sometimes up to 6 months, for positions to fully reflect, views here. And so this is why we hit the top, and now we're on the opposite side. Now we're on the flip side, where expectations had gotten, we're just, I don't want to say that expectations got too high. Let's just say that for the regime that we were in, we maxed out at the expectations for that regime. And now the regime has flipped, and so now the market needs to, shift down to the new regime. So there's the macro, or there's the monetary policy regime, which shifted last week. And a shift in the monetary policy regime should have shifted the bond market. So we saw the bond market shift because of that, right? The next thing is we have a flip in the macro regime. And the flip in the macro regime means not just a shift to the bond market, it means a further shift in the bond market, but also now a shift down across asset. Because at the end of the day, your economic growth rate is an input into your output for asset pricing, whether it's equities, and everything else. So in this dynamic, we're just going to continue to see that positioning, reflect. And the thing is that, investors, by and large, they take active weights based upon, where they think, how they believe that assets will correlate given a regime. Everyone had piled into equities, because of their view of the regime, which was, okay, we're going to have a higher for longer interest rate policy, and we seem to have pretty resilient and robust economic growth. So given that regime, it just made sense to, okay, I'll take active weight or active risk on equities. But the thing is that because at the beginning of the year, people were so underpositioned, they just had to chase the markets higher. And so you had this massive chasing through the first half of the year. In the second half of the year, there was chasing fatigue, and so you had the broadening out trade, right? This is what drives factor rotation. It's really, at the end of the day, a result of like macro positioning and how people were positioned previously, and then the marginal subsequent positioning of investors, right? Because like if at the end of the year in December, or at the end of the last year in December, you were like, you had cut your equity exposure because you thought that we were going to be in a recession, right? That's what everyone on the street was telegraphing, a recession in the first half of 2024. So the market was pricing in 7 cuts. You're like, PE multiple is sitting at 20 times. Your EPS is depressed. So you have a very low equity positioning because of this. And you built into that positioning through November, okay? And then at the end of the year, end of the year happens. And then what happens is data continues to surprise to the upside. People began to shift their thinking, and now they have to like add equity exposure. And so what are they doing? They're going to add equity exposure by like buying a bunch of call options. They're going to buy equity futures. They need to get that exposure. They're going to buy all the mega caps, right? They need it. They need that. They need to put that risk on. And so you kind of get this. You get this impact from positioning. I don't want to say that like 2024 was a mirage in hindsight, but I think that's like a good way to understand it, which is like, should the market have, if the market like was able to track economic data like effectively, how should have the market traded? And ultimately, we should have seen EPS estimates probably around where they are here, and we should have seen interest rates maybe a little lower. So we should have seen a little bit of a multiple expansion, in the S&P. That would have been fine. instead we had two things. We had a big multiple expansion, and we had a big, EPS growth rate expansion. And so those are the things that are now fading because we're flipping, in the regime. So, where do we go from here is the big question. It's not just about what's going to happen this week, what's going to happen next week, this month, next month, right? This is the flip in the regime. Again, the beverage curve has shifted, or we're down the beverage curve, and that means that the risk to upside in unemployment rate, pretty much when you hit to the down part of the beverage curve, you're now in the part where the unemployment rate is nonlinear. And so who knows what's going to happen with the unemployment rate is the question. And that is definitely a concern that the Fed has. Now, does that mean that we have to go into a recession? No, again, that's not our base case view. We think that, the growth fundamentals in the economy are decent enough for, like, even if we get a small contraction, it won't really be, that big of a deal, because the number, or like the level of unemployment, or say of employment, is still pretty strong. And we also think, so here's another thing too, okay? We also think that the impact from immigration is largely done. So if you were if you had a DSGE model, or if you were a street economist, or at the IMF, and you have a forecast of what your immigration rate was over the next 2 years, then you saw that your labor supply was increasing, right, dramatically, and you saw that the job market was cooling. And so what is your unemployment rate forecast going to be? It's going to shoot up like crazy, right? Because you're estimating that there's going to be like another 1 to 2 million new, job seekers that didn't exist before. My view is that that's probably not the case. We're not going to get as much net flow in immigration as forecasted, as expected. And so because of that, that limits like the, I'm sure there will be some crazy downside scenarios that we see on the street, and they will be because of these expectations of this like big immigration surge. But if you have a more balanced view of immigration, where you're like, okay, well, immigration is obviously elevated, but it's like it's cooling. It's already cooling, if that's your perspective. And of course, I've shown you guys the charts of border crossing data, which shows that we're actually below where we were in fiscal year 2021. Then you would know that, okay, well, that number seems to be abating, not accelerating, and so therefore the impact of the unemployment rate is still going to be real, but not as bad as what might be expected. Okay, so ultimately, it's like we understand that the regime has flipped. There's a terminal shift, right? This is like a longer-term thesis of growth is being derailed, right? There was a view out there that R-star was much higher than expected, and that view now is dealing with reality, which is that's not the case. Couple of things, okay? Some risks to the view, which are, well, hey, did Hurricane Beryl, right, obfuscate the July non-farm payrolls? That's a good question. We looked at the numbers, and what the numbers show is that the jobs that were disproportionately impacted were white-collar workers. When you have a weather-related effect, it tends to disproportionately impact leisure and hospitality and food service workers. So what that tells me is that the impact from weather is much smaller than people are expecting. And ultimately, that means that the give back is going to be smaller than people are expecting. So there might be a positive contribution back to September, but it's going to be smaller than people expect. So this is the key thing. I think that's really important to consider. The other thing too is that the response rate was quite low. I think it was 56% when the non-farm payroll was published. And so that means that we're going to get a big amount of revisions in the next print. And over the past 6 months, the revisions have tended to be negative. This is because we're getting closer in line to the balance with the birth-death model as we almost end the full year mark before those numbers get revised. Okay, so I would expect that a negative revision, right, would offset any positive givebacks from the weather effect. And so again, I don't think that we're going to get some positive information. We'll get evidence of this on August 16th when the state level data comes out. So this is like the catalyst calendar. The narrative right now is going to be super focused on the labor market. I don't think we're, inflation that's, coming up next week. It's not going to be this is not going to matter that much anymore. I mean, it still might move things, in the short term, but we're now on the path for a 3+ rate cut dynamic. And I think that the base case now is like 50, in September, and then 25, for the rest of the year. I think that's probably about right. What does this mean for asset classes or for the S&P? That to me suggests that we still have some downside in the S&P, given the fact that there's still a tremendous amount of crowding. Like I said, most of 2024 was probably a mirage. That tells you that the market is going to have to reprice, and a repricing event, depending on how it goes, can either be extremely painful or it can happen in a smooth fashion. My estimate right now is that we could get down to like a 20.5 times NTM PE on the S&P, which is consistent with where PE was at the beginning of the year when the market was pricing in 7 cuts. In that environment, if we get a 20.5 PE, my EPS forecast for next year is revised down marginally. I think right now 2025 EPS growth rate is around 13%. I think we're about half that. That gets me to like an NTM EPS of like 240. In that dynamic, we're getting to an S&P level of like 4,900. Okay, so we could hit that, what we saw in April, where the market, took a downturn. And I think that would be like a little bit of a clearing event, and get things positioned a little better. Now, one of the things to understand is, where is everyone crowded, right? That was a question that you had, which is like, how do you manage for a crowding in trades? This is the thing that keeps every PM up at night. This is why we have to look at factor exposure and attributions, right, in the portfolio. And I want to know, like, what's my exposure to the quality factor, to momentum, to value, to interest rates, to all of these things, because I don't want to take disproportionate risk if I don't have an active view. And even within my active view, I might have risk parameters that I have to, fit in, right? My strategy says I have to stay within a 20% net of any factor, and I'm 40% net, then that means that I'm well above my risk limits, and I need to cut that risk. So this is like a key thing, that we're have to constantly think about and assess. And I would say that a challenging dynamic right now is that all of the factors, look bad. So what do I mean by that? Well, so the way that in the literature, right, the way that most market participants are going to establish a factor is just going to look at the factor's return through a period, and that period is typically the last 12 months. Okay, or the last 12 months, the LTM, right, where the weighting of the last 1 month is diminished. Okay, so imagine that you would like average, the returns over the last 12 months, but you would reduce the weight of the last month. And the reason for this is there tends to be a short-term reversal factor, which is over the last 1 month. So all of your factor returns, right, they're going to show, they're going to still be, pretty high on a trailing 1 month or trailing 12-month basis, and they're not yet going to show the decline because the 1 month again is depressed, or like it's underweighted. So because of that, you're going to be, you're like, I don't want to say you're flying blind, but you have to then like estimate your factor exposure in that 1 month period, which is really hard to do. So what do PMs, what do like investors do? They'll degross in a situation like this. And I think, and so this is largely what's been happening. There's a big aspect of degrossing, which I think is happening on like the hedge fund side, but there still needs to be some repositioning. So it's like you're going to have a mix of degrossing and then a mix of repositioning, and then ultimately, that's once once that positioning and degrossing is done, then the markets can rally and move forward, even if we have a little bit of contraction. When would that bottoming occur? Yeah, it depends on where the market is, how the market is positioned in front of the catalyst. I think right now we're looking pretty good. The market is at four plus cuts by December, which I think is probably about right. Where are we on the S&P? Well, we're at like 5250 roughly on the S&P. I think that S&P probably has more room to go down. I think at this level, you're expecting not that much of an impact to your earnings growth next year. And I think that's I would my view of a 6% growth rate might be too conservative for sure. We might get like an 8 to 10% growth rate down from a 13% growth rate, and which might support like a 5100, or 51 handle on the S&P. But I think that I'm still skewing a little bit on the downside, and the reason why is because there's still I think that if you get the September print for NFP that I'm expecting, then that would show that the unemployment rate is moving higher faster than expected. And in that scenario, that would imply that even in 2025, the number of cuts that are being priced in, which I believe is 10 cuts, would need a rise. And we'd get a lower terminal rate. Terminal rate would be below, say, 3%. We'd probably get like a 2.5% terminal rate. The 2.5% terminal rate would imply, I think, a 1 year, inflation swap. 1 year is pointing to like 2% inflation. So that would be like a zero growth environment, or just like a marginal growth environment for the economy. Again, I don't think that necessarily has to come, but I think that would become a much bigger scenario concern. Probability of that scenario becomes very high. It becomes more than a 50-50 chance that we enter a recession if we get the beverage curve, if we're slipping down the beverage curve. So in that scenario, that it would make sense that next year we get to a 2.5, say on the SOFR or Fed funds rate. That would imply, again, close to 0% GDP growth rate, which would be consistent of like the market pricing in a recession, or at least like a flat growth environment. I think for sure that a weak September print should shift that. Like that's exactly the take. If you saw the unemployment rate slide from 4.1 to 4.3 to 4.5, right? Your takeaway should be, I may be entering into a recession. So, and then in that scenario, I think that pricing makes sense. So that would be the catalyst for that, a further leg down, and that would probably drive the whole market for like the next, quarter, the next 2 quarters, and probably cause a lot of concern. If that becomes the base case, or like a 50-50 chance, then it means that there's worse scenarios too, which is like, what if this turns into like a really bad problem, right? What if unemployment goes to 5%, 5.5%? So those scenarios become alive. You could say that the gamma on those rises as we get data that looks truly worse. Now, is it possible that data looks better? Yeah, I mean, for sure, it's definitely possible that we get better data. We'll get a sign when we get the NFIB data early next week. NFIB, Small Business Optimism Index, and their report is, it's probably a better signal. It's definitely a better signal than ISM's and S&P, PMIs. That data has been weak, but it did seem to trough around April. So for the past 2 months, it's been moving up from a low. So, there could be some, the economy doesn't have to be materially slowing down as quickly, right? We might still have some time before the beverage, curve comes in. However, I think a big risk is if monetary policy doesn't adjust, right, if the Fed pushes back too much against this, then I think we do have a risk of a greater, negative effect, right? If the Fed is like, oh no, we would not even think about a 50 basis point cut in September, then I think for sure you start getting into like a little bit of panic mode, and then you would see the market start to price 25, 50, 50, or 25, 50, 75, or 25, 50, 100. If the data gets materially worse. So it's going to be really important to see because we got the August state data on the 16th, so in 10 days. We got NFIB next week, so in like 5 days, or 6 days, 6 days, 7 days. We then get CQ data on the 21st. We get Jackson Hole at the end of August. That's when the Fed is probably going to communicate something about, their positioning for September. Then we're going to get September non-farm payrolls, first week of September. That it's towards the end of September that we're going to get the FOMC meeting. So the Fed has a couple of opportunities before the September non-farm payrolls to communicate what its stance is. So far, it's pushed back a little. Okay, and what I mean by so far is Austin Goolsbee. He's like a non-voting member, but he has been for sure pushing back a little. But I'm not sure if he's pushing back against a 50 basis point hike or just like an intermediate hike. I don't think that we have any chance of an intermediate hike unless we get a blowout in credit spreads, unless we get a big blowout in the credit market. But otherwise, Fed has never done an intermediate cut just because unemployment rate is rising. So, that's kind of the outlook. That's like the tea leaves, I would say. And the tea leaves make me a little cautious, I would say, given the positioning. There's and that we're still very early in this process. It does make me worry that we'll see a leg up in the VIX again. When would that happen? It could happen if we get initial jobless claims that get materially worse. I don't think that they'll show signs of much weakness until the later half of August, which will be after the 16th. I think the 16th will be important because it'll prove or deny the thesis of Hurricane Beryl's impact on non-farm payrolls. If it disproves that thesis of the weather effect, then I think that you could get a little bit of a reaction. But I don't think that we get a real negative response until September. And the reason until the non-farm payrolls. So I think that's when you would have like the big risk event. Could there be something that happens before then? Yes. For sure, there can be things like if we get again a big pickup in initial jobless claims, some data point like that. But I think that from a labor market standpoint, I don't think there's any like big surprise. We would get like marginal grinds unless there's like a big positioning overhang, right? But I think that what we just experienced was that big positioning overhang. I mean, not to say that there still isn't positions that are overhung and need to be trimmed, but that we're in a situation where a big portion of that has been adjusted. And so where rates are today, do I really see that there's going to be an event that's going to shift them dramatically? It's hard to see that in the path of data coming out. I mean, the only potential thing that could do that would be if CPI misses dramatically. But I don't have a reason to think that CPI will miss dramatically. I mean, in the data points that I look at, it looks soft. Consensus estimates are for like 2.2 to 2.25 or 2.24 roughly. But I don't see anything that tells me that it could be well below that. That's kind of my take on where we are right now. So cautious. I don't see a blowout in the next couple of weeks. I think that we get a grind lower. And then the next case for a potential dislocation would be after the September Any thoughts?
On the meeting, do you guys want to chime in?
Always insightful stuff. I've been really trying to focus on my studies, but the market has other ideas.
I think it's because it lacks your attention, and the market's being like a little child.
The market missed Barnaby.
Yeah, I think that's a primary reason.
That's right.
But yeah, I agree. I don't see a CPI downside though.
I mean, so there are a couple of things that are pointing to like a little bit of cooling, but on the flip side, like I'm seeing like a balance of things. Like for example, sure, like gas prices are looking a little lower, but at the same time, I'm looking at like the Zorby, and rents seem like they're not falling off a cliff. New tenant rents did fall off a cliff, but that was last month. It's possible that slides further.
So are you suggesting that if we have a fell off in CPI or PCE, then the Fed can cut more?
No, what I'm saying is like, so there's like, what would cause a big sell off in the market? Mainly one of two things: positioning and or data. Like those are the two things that cause big sell-offs, right? Positioning, mainly you'll see that through the VIX. VIX spikes like crazy. You get some major dislocation. That's kind of what we saw on Monday, right? You get this like from an overhang in position that has to shift really quickly. And by the way, the regime of that caused that shift, it still exists, right? So like the regime that flipped was you have a weaker U.S. growth environment, and so the rate differential between yen and dollar is narrowing, which will strengthen the yen against the dollar, right? So like that regime is flipped. Now now the yen is just going to rally against the dollar, unless obviously the yen or like Japan falls into a recession or something, right? Otherwise, we're now in the flip of that regime for carry. Carry has inverted. Actually, what Annie, maybe if you want to ask around, I would ask about lira euro funding or lira dollar funding.
You were talking about it, right? The Middle Eastern funding.
Yeah, there's some funding that's happening from the Middle East. I don't know exactly which currency it's coming from, but there's a currency in the Middle East that's being used to fund exposure.
So I do have this question though. On FX, most of the Middle Eastern currency are pegged to dollar. Right. So when you're pegged, you won't even have any of the carry trade, right? There's no way you can have a carry trade if you're pegged.
Right.
So it will only be the floating ones.
Right.
Apart from Turkey, shekel, what are the other ones that are floating? I need to double check that. I need to have my old FX watch list back.
Right. No, I mean that's why I said the lira. Like take a look at the lira.
So wait, you think it's lira?
Yeah, I think it's the lira. Yeah.
So actually, Turkey inflation has been cooling off quite a bit.
It has been cooling off, but it boils down to what. So think about it like this, okay?
Mm-hmm.
Turkish monetary policy is very high. What's the funding rate in Turkey?
Like super high. I haven't checked recently, but $52%.
Right.
That's a reference rate, but like, yeah.
Right. So if Turkish inflation is falling,
they got a cut
what
rate.
do you think is going to happen with monetary policy?
They got a cut rate from 50%. Right? Yeah.
And are they going to cut? There's a lot of room to go.
I think the normal range for them is like 750 basis point or something.
Yeah. So
So,
in that environment, you have a currency that's going to depreciate. So that's where the funding is going
through. That's an interesting view. I'm gonna ask around on I saw the discussion in the chat, and I was like, most of these currencies are pegged.
Yeah.
So you're trying to find currencies other than yen who's having a depreciation issue.
Right. Structural depreciation issue.
How about China though? Or is China too close with the trade? It needs to be something that's smaller.
The thing about China is that who's going to use Chinese currency for a carry trade?
Yeah, the offshore market is just like a smaller one. I mean, there's like the offshore.
That's right. Yeah, offshore is way smaller. I think that's something I can take a look. Yeah, Turkey sounds about right. It fits the narrative. Yeah, I'm gonna ask around. I'll wait till I think Shanghai is almost in, so I'm gonna ping them.
There you go.
Yeah. So what is the argument post, like, if we find out it's Turkey, then what are we doing here? Or like, what is the narrative behind it? Will you see the cross between Turkey and yen widen?
No. So the problem, if it's Turkey, if you look at where the USD TRY is, right? Like dollar lira.
Dollar Turkey is.
It's just been moving up in a, off to the right, like it's like a straight line, right?
Bottom left to top right kind of chart.
Right. And so that could be a sign of like implicit leverage. So there can be a lot of leverage in the lira because of this, or like this could be part of what you're seeing. Could be carry. I mean, a lot of it is rate differential, okay, but a big part of it could be carry. And so that's what that JP Morgan guy was saying, which was when they're looking at the lira, it potentially is a sign of increased leverage. And I think that the risk here is, when Billy Wang did his variance swap trades, I think a lot of people saw what he did and were like, okay, it didn't work for him, but it might work for us. And
I see. Okay.
And maybe not in the defrauding, Credit Suisse and all the other banks, but in the sense of, what if we take these really aggressive levered positions and just use that to like massively grow our wealth? And I think that you kind of get some of that attitude from like, GCC countries. So the theory is that GCC countries, or like investors in GCC, are using carry through the lira to invest in, say, like dollar, denominated assets.
Wait, so does that mean you're gonna borrow in lira?
That means you're borrowing in lira.
But that's like 50%, right?
Yeah, but because the lira keeps falling.
So you're saying like annualized lira is gonna fall more than 50%.
Right.
Ooh, okay. That's okay.
Well, that's been the case. Okay. But now we're getting to a point where the rate differential may flip. Or not necessarily flip, but it might shift.
Right. So you've got, but you got like both central bank cutting, but
right. So before,
lira is
if
gonna
like
cut.
the U.S. if you said the U.S. is in a higher for longer regime, the
Uh-huh.
terminal rate is going to be at like 4.5%.
Right.
Okay. And then the lira rate would go from say 50 to like say 25%.
Uh-huh.
Okay. So either you made money because the lira was depreciating, like the lira will always depreciate against the dollar in a higher for longer scenario,
Yeah.
because it's just there. It's not that the lira is going to be in an environment where it's going to have 50% interest rates and inflation of 2%. That makes sense,
Oh, right, you're comparing the real rate. Yeah.
right?
Okay. Yeah. Yeah.
So with
Uh-huh.
that differential flipped, that means that this is now a bad trade, and there may be some, leverage, in there.
I'm gonna poke around and see. That's an interesting thought.
Yeah, I mean, this is just a little bit of a hunch, so it's like nothing serious, but I wonder if this could be a little flashpoint. I don't think it's going to be that big because obviously the dollar lira market, it's not massive, but it's worth exploring.
Right. And they also have the bilateral swap agreement with China. Like the China are having this deal with the Turkish government that they are like swapping their Turkish lira with RMB so they can buy Chinese products. But on the other hand, Chinese are holding these liras that are plummeting. So it's like a deal to buy vote, I think.
Interesting. Yeah.
And there has been some criticism on Chinese social media. I'm sure Yafeng knows this on Zhihu. Is saying like, why are we doing this and so on. So yeah, so if lira strengthens, that's helping China as well on that part of the deal. I don't think it's going to be a huge deal.
Check lira price, and it's not strengthening at all. I mean, still like selling.
Right.
Right. I mean, if it happens, we're too late to the game.
Right.
Okay. That's just okay. I can just search a little bit as well. Let's.
Yeah, I mean, I'll do some scrubbing on that. So yeah, okay. Because and one more thing is, just on the Japan side, I mean, BOJ is still like last week before this happened, they still try to be like hawkish, saying there's more to come. Do you think that's out of the table now? Like
It just
the
depends
rate
on the
hike?
performance of Japan. Right now it looks like Japan is, what you said was, that the companies were seeing a profit because of the weak yen. But if the yen now has strengthened, then that flips the regime, right? So
Yeah.
So I mean, that you got to take that seriously.
But why would a company guide that? Like normally I'll stay out of the FX.
Well,
I wouldn't even
companies have to list if it's material, right? Like, and the thing with Japanese exporters is that that exporting is their business. If they're selling to an American company or whatever, then it's like
like
it makes
Toyota,
sense.
Aizen, Denso, these in the auto supply chain.
Right.
Right. Yeah, so if that's the case, then the money they make in yen is going to be materially lower. Then wouldn't that like eventually trickle down to lower wages, lower CPI?
Yeah. I mean, that's the whole. That's if the currency flips back to being weak again.
If it's weak again, then obviously you can hike, right? Because that theory doesn't stand anymore. You will have domestic inflation.
Right.
Just because you're making more foreign exchange, paying people more, and then people buying stuff more. But if you have the reverse, then they don't need to hike again.
Right.
Like at least in the near future.
Yeah. So I
So,
think
yeah.
that with the shift in the rate differential, this means that the Japanese carry has flipped. Like that was like my point
Mhm.
earlier, which was
Right.
the regime has flipped, and that the rate differential now is going to widen between Japan and the United States.
Right. So I guess on the catalyst calendar, we need to add in Tokyo CPI and Turkey CPI.
Or at least their monetary policy,
Yeah, on monetary policy stance. Because that, if that hasn't happened yet, and if it's we're early to the game, then there's definitely multiple ways of playing this.
Right. I think the way that we should see it right now is that these are like shoes, that could be dropped, right?
Yeah.
So, a big dislocation that happened in Japan was, obviously when the carry first flipped, because what
Mhm.
happened, what Yafeng was saying, which was that, it was, Japan was pretty much closed, when we got the U.S. data, right? And so when the U.S. market, when the bonds, got bid, the rate differential flipped between Japan and the United States at that point.
Mm-hmm.
And so that flipped the regime. Now we're in that regime now. Like the cat's out of the bag. So moving forward, this is going to be a headwind. This will strengthen the yen.
Yeah. Oh, for sure. Yeah.
So on a stronger yen, how is that going to impact Japanese exporters and Japanese businesses?
Oh, it's going to hurt them a lot.
It's going to lower inflation, but it's going to hurt sales.
It's going to hurt sales. Yeah.
Okay, guys. I think that's
all right.
all from me. I gotta go wrap up my notes.
You have tons of information that we just unpacked there. Yeah, and I'm gonna wrap up my notes as well. So, let's wrap it up and talk tomorrow.
All right, sounds good. Thanks, guys.
Yeah,
for
great.
Just one way. I probably want to see the JPM like FX reports. I mean,
oh, yes.
Yeah, I mean, sometimes we forget, but yeah, I mean, from like the other perspective, it's just like BOE cut 25, RBA stays put. I mean, there are still like some central bank action that we didn't cover, but I mean, this is just kind of like a summary. I mean, RBA didn't cut, so interesting.
Okay. Cool. Let's leave it there and let's reunite tomorrow. Hopefully, it's not a bloodbath anymore.
Oh, there will be more bloodbath. I'm waiting for the
No, I
central
mean
leg
tomorrow.
down.
Oh, okay. Now I know your positioning. Let's see. Okay. Yeah. See you all tomorrow and take care. Bye, guys.
Bye bye.
Bye. Thanks, everyone.